Well, hello everyone to week 5 of the massive open online course for the University of Nicosia's master's degree in digital currencies. I'm Andreas from Antonopoulos. I'm your teacher. This week, I am broadcasting from a hotel room in Florida, where I am attending a trial as an expert witness to explain Bitcoin to a jury. So, not my usual studio setup. The lights are a bit wonky. We'll see how the Wi-Fi plays out. I hope you enjoy this wonderful painting in the background. Oh no, it's on this side. There you go. That's the best we could do under the circumstances. But in any case, I'll be answering your questions, and hopefully we'll be able to pull through this without any technical problems. So let me know in the chat if you can see and hear me okay, and if you're excited to learn today. Our first question comes from Victor. Victor asks about segregated witness. I don't fully grasp how segregated witness works. Can you kindly break it down and how it solves transaction malleability? All right, so in very, very simple terms, transaction malleability is caused when you can change a transaction in a way that doesn't change its semantics, its meaning, but it does change its hash, its transaction ID. And transaction malleability is caused because primarily because of the signatures in a transaction. So in the original design of Bitcoin, the transaction ID was calculated as a hash over the entire transaction, which included the signatures on the inputs. Now, signatures in Bitcoin use a specific encoding, EER encoding, that is common for ECDSA signatures. Unfortunately, it's not standardized, and it was fairly loosely interpreted. Because of the way the scripting language works, there were many opportunities, both in the scripts and in the signatures, to basically change things in a subtle way without the meaning. Let's say, for example, you had in the script there was an arithmetic equation, right? So if you take the script and you add to it +1 - 1, the end result is the same. Something similar can be done to a signature. If instead of writing a signature as, let's say, 0, 1, 2, 3, you write it as 0, 0, 1, 2, 3, it's still the same number, 123, but the bytes you use to encode it are different. So if you make a change like that, the signature will be the same, but when you hash it, that small difference in the byte encoding will change the transaction ID radically. It's going to be a completely different transaction ID. Now, I don't need to have the private keys to generate a signature in order to do that. I can look at a transaction that you've broadcast. Let's say you just broadcast a transaction. I can go in there and I can look at one of the inputs, look at the signature, and see that you've signed it with a signature 0, 1, 2, 3, and that signature is valid. Everyone can confirm it. They'll do the mathematical calculation. 123 is the correct answer. You fit it into 4 digits, let's say, for the example's sake. And now I take that transaction, I change it, I rewrite it so that its signature is actually 0, 0, 0, 1, 2, 3. I've added 2 digits. It's now, instead of a 4-digit encoding, it's a 6-digit encoding. But importantly, it's still the same number. It's 1, 2, 3. It's the number you produced, which actually is a valid signature for that transaction. But because I've encoded it slightly differently, if you take that transaction and hash it, it will have a different transaction ID. If I then broadcast this malleated transaction to the network, there will be, briefly, in the mempool, 2 transactions with 2 different transaction IDs attempting to spend the same inputs. As we'll see in an answer to the following question, of course, only one of those transactions can go through. You can't double spend. The transaction malleability has nothing to do with double spend. One of those transactions will go through because they're both valid. Now, what happens if my transaction, the malleated transaction, goes through? Well, it will be valid. It will spend the inputs. It will send those amounts to the outputs that you chose. But on the blockchain, it will be recorded with a completely different transaction ID than you anticipated. Now, this is a problem for 2 reasons. The first one is that you are unable to find it by its original transaction ID. Second problem is, if you have a child transaction that refers to it or anticipates it's going to refer to it, you've built a transaction anticipating that it will have this transaction ID, ends up getting recorded with a different transaction ID, your child transaction, which has the transaction ID it's spending from encoded in it, is now invalid because the transaction ID the child refers to no longer exists. The parent has been renamed, if you like, and as a result, the child transaction is invalid. This becomes a very big problem when you want to chain transactions together in a smart contract. For example, in the Lightning Network, you have channel funding transaction, and then you want to have a refund transaction just in case something goes wrong. Well, that refund transaction isn't going to get broadcast until later, so you hold it. But that refund transaction has the transaction ID of the funding transaction in it. If someone malleates the funding transaction, your refund transaction is now useless. It doesn't work because it has the wrong transaction ID in it. So that's transaction malleability kind of in a nutshell. Now, reopening my device here. All right, so what does segregated witness do? Very, very simply, what segregated witness does is it takes the signatures from inside the part of the transaction that gets hashed and puts them in a different place. It puts them in the witness tree in the Coinbase of the block. So when a transaction is transmitted, a segregated witness transaction, it's transmitted in two parts. It's transmitted as the transaction itself, which has no signatures in it, and a witness package, which has all of the signatures for that transaction. So the signatures are still transmitted, they're just transmitted in another part of the data structure. When it's mined as is. Again, the signatures are not in it, but the signatures, all of the witnesses, are put in the block in a different part in the witness tree. So signatures are still there, they're just in a different part of the data structure. And what that means is that when the transaction is hashed, because there are no signatures in the transaction, the hash is always the same, and you can't change it because all of the other things in the transaction cannot be malleated without changing the semantics of the transaction, and because all of the other things in the transaction are committed by that signature. So the signature becomes invalid if you try to malleate them. So segregated witness simply is moving the signatures out of the transaction data structure so that its hash does not depend on the signatures. That's all it is. Julian asks, can SegWit spam the network? If SegWit increases block size, can it spam the network? If this could be possible, could it fix the scalability problem? Well, SegWit doesn't increase the block size infinitely. It simply changes the way that the calculation of the space that is taken up by the witnesses is made in the nodes that validate blocks. So when blocks are validated, they provide a discount for the data space that's taken out by the witnesses, so that the witnesses, the signatures that is, are counted as much less space. Essentially, the weight of the signatures is discounted 75%. So that gives you the ability to put more transactions and more complex transactions because you get a discount on the space that the signatures take up, the witness space. Other than that, it doesn't really change much. That discount is enough to go from about 1,000 transactions a block to about 3,000 transactions a block. And we've seen that since 2017, that the number of transactions per block has increased because of that discount. The more transactions in the block that use segregated witness in their inputs, the more you can earn that discount when you send that transaction, and the more transactions can be fit into a block. Now, not all transactions do use SegWit. Even 4 years after the introduction of SegWit, I think the adoption is about 70% of the transactions, maybe a bit less, that actually use segregated witness. So the discount isn't being used by everyone, which is unfortunate because that means additional fees for those who don't use it. All right, let me quickly check in the chat and see how things are going. Oh, about that. Let's Very good. Yes, hello everyone. Everything seems very good. Very Florida style shirt. Well, thank you so much. But actually, KF Chan actually pointed out it's a batik shirt. It's a style that is particular to Indonesia, and it was given to me by a friend and Bitcoiner from Indonesia. So there you go. The University of Nicosia only delivers the very best in flowery shirts for our presentations. All right, so Lydia has a follow-up question to this, which is segregated witness means. That's a great question, Lydia. Here's the thing. One of the things you'll notice about Bitcoin is that engineers who design systems are not always very good at naming them. Segregated witness is a technical term that was used to describe the feature. In cryptography, a signature, or something that validates spending, in this particular case, that commits to a specific transaction, is called a witness. So the technical term for the part of a transaction or message that validates its integrity, that authorizes it or authenticates it, is called a witness. So signatures are witnesses. And keep in mind, signatures are not always simply digital signatures. They might be scripts that validate a locking script in the Bitcoin scripting language. They don't have to be a digital signature. They could be multiple signatures for multisig. They could be some script condition. They could be a hash pre-image for a Lightning channel. So all of those things in general are called witnesses. So what do you call it when you take the witness and you move it outside of the transaction? So that's called segregating. It's basically taking it and moving it to a separate part. So separating signatures or segregating witnesses means the same thing. Segwit simply means separating signatures in a very technical wording. Every time I look away, my tablet locks and I have to unlock it again in order to look at the next question. Sorry about that. All right. Next question comes from Parva. It's a bit of a follow-up on what we've already discussed, which is in transaction malleability, a hacker can only get multiple transactions by manipulating the witness data and making a new transaction. But the input of that transaction will refer to a specific UTXO. How can that be spent twice? It can't, Parva. That's a very good observation. Transaction malleability does not allow you to double spend. It simply allows you to execute the same transaction that the sender initiated and intended, spending the same money and sending it to the same people or the same addresses for the same amounts. It doesn't allow you to change anything about the transaction except for its identifier. So all you're doing is you're transmitting the same transaction that somebody else created, but you're transmitting it in a way that it has a different transaction ID. Now the network will see that both the transactions are spending the same input. And if you transmit it fast enough, they may accept your malleated version before they accept the original version. And if they do so, then the malleated version gets recorded, and then the sender is very confused because they can't find the transaction they created by the same transaction ID. Interestingly enough, one way that we malleate transactions on purpose by reapplying signatures, which we can do, is when we want to bump the fees. Keep in mind, when we're talking about transaction malleability here, we're talking about third-party transaction malleability. That means someone else is malleating the transaction I sent without my authorization. And in order to do that, they can only do that before SegWit. They can't do it with SegWit because transaction malleability is not possible when the signatures are separate. But I can malleate my own transaction. Of course I can. Because I can create a new signature. And so what I can do is I can take the same input and spend it, and this time pay maybe a bigger fee. Now, in order to do that, I'm going to have to change the transaction. I'm going to have to sign it again and then retransmit it. So that transaction goes out. It's got a slightly higher fee, and then it gets confirmed, let's say. And so the new transaction ID is the one that's valid. So when you use something like replace by fee, which is a fee bumping technique available in many wallets, when you increase the fee of a transaction you've already sent, you're effectively malleating your own transaction on purpose by re-signing it, and that will increase the fee, change the transaction ID, and it will get confirmed. Sometimes your recipient will be confused because they'll see a transaction coming into their wallet, and it will never get confirmed, then it will disappear, and then another transaction with a different transaction ID will appear that will get confirmed. So those are the exciting aspects of transaction malleability. All right, the next question is about the Lightning Network. Travis asked, what would happen with a Lightning Network if you had a storm of nodes closing their channels and you have a contraction in capacity? The settlement of channels will require recording transactions in the Bitcoin network to close the channel. If you suddenly had a burst of such transactions, and the transactions per second of the Bitcoin network are about 7 transactions per second, what would the impact be to the two networks? Well, in simple terms, the impact would be that people would not be able to close their transactions as quickly as they wanted to, and they may have to use various fee bumping techniques to increase the fee they pay to close the transaction. And that's going to cause the fees for closing the transactions to go up significantly as people try to compete with other people closing transactions. Now, why would you have lots of nodes closing their channels at the same time? I really don't see a scenario where that would be necessary. One of the important things about the Lightning Network is that you don't need to close a channel, really, ever, unless the other party disappears and is no longer operating the channel. You can just keep operating it. You don't need to close the channel to get your money, because your money is on the Lightning Network and you can use the Lightning Network to spend it. So if I get paid, I don't need to close the channel to redeem that money or settle it. I can simply spend it again on the Lightning Network. And in fact, I don't want to close channels. I want to keep channels open for as long as possible. A more interesting scenario happens if you had a lot of people trying to open channels at the same time, which is the kind of scenario that would emerge if, let's say, a country adopted Bitcoin and Lightning Network as its main currency, as happened in El Salvador, and you tried to have, a couple 100,000 people try to open Lightning channels. And this is a significant constraint. You can't open that many channels at the same time. So there are a number of ways to get around this, including waiting or using a semi-custodial trusted service to open channels for you, or to open channels and hold keys for many Lightning users, which of course is not ideal. So there are some issues there with capacity in the Bitcoin network. Essentially what the Lightning Network does is it amplifies the existing capacity of the Bitcoin network. So if the Bitcoin capacity is X, the Lightning Network will multiply that and say, okay, well, we can do 10x or 20x or 300x payments with the Lightning Network than we could do on chain. But that doesn't change the fact that you still have a capacity constraint on the base blockchain. All right, so the next question comes from Brett, and it's about wallet suggestions for DeFi. We're actually going to leave that for week 12, where we cover DeFi, and there's another course for DeFi, but I'll just briefly answer it and give you my best sense. What advice do you have for which HD wallet for me to use if I'm involved in DeFi and also holding? For instance, on a daily basis, I'm interacting with Tezos, Cosmos, Algorand, DeFi. I also hold numerous other assets on Gemini and Coinbase, and I'm primarily holding. Is there one wallet available where I can store my crypto and also use this same wallet to interact with DeFi, claiming, staking, etc.? For the most part, what I have done in the past is I've used a hardware wallet, and then I use a software interface to that hardware wallet in order to interact with various smart contracts. The most popular software interface for that, of course, is Metamask. And you can use Metamask with a hardware wallet so that Metamask interacts with the blockchain, with Ethereum or other blockchains. And then in the background, Metamask sends transactions to your hardware wallet in order to have them approved. There are others. MyCrypto, for example, is a desktop wallet that you can use with a hardware wallet for Ethereum. as far as Tezos, Cosmos, and Algorand, various other options you might have for other chains and what wallets are available there, I'm not really that familiar, so I wouldn't know how to advise you. And I don't know if there are good wallets that you can use everywhere. However, what I do know is that a hardware wallet can support multiple cryptocurrencies. It can support Bitcoin, it can support Ethereum, and of course it can also support a variety of both Ethereum tokens and alternative chains. So you can use a hardware wallet with multiple cryptocurrencies on a single backtop seed, and then you can use a variety of software interfaces as needed to interact with different platforms. You don't need a single software interface. So you can use one for Ethereum, you can use a different one for another chain, let's say Cardano or Solana or whatever. You can use specialized DeFi wallets that support hardware wallet backend for specialized DeFi applications, either on Ethereum or on other platforms. I hope that helps. Libby asks, can you please elaborate on the purpose of getBlock template call with regards to solo and group or pooled mining? Yeah, so when you're mining, the first thing you do in order to start mining, before you start mining, is you construct what we call a candidate block. So the candidate block is the block that you will try to find a solution that will satisfy the proof of work requirements. And you'll take this candidate block, and at first it will be empty. You'll put a link to the parent, which is the block you think is the most recent block on the chain, and you want to make this one its child, so you link to that as your previous block. You put a timestamp, you put some other information, you put a Coinbase transaction in that pays you the reward, and then you start adding other transactions from the mempool in order to fill that block with transactions and earn all of the fees. Once you've constructed this candidate block, you then start trying to find a solution to the proof of work. Now, if you're mining solo, you construct the candidate block, you put whatever you want in there, that's it. You don't really need a get block template. You don't need to get the block template from anyone else. Your mining node constructs the block template, the candidate block, on your own machine. You're paying the Coinbase to yourself because you're solo mining. That's it. But if you're mining as part of a pool, first of all, the payout doesn't go to you, it goes to the pool. And so therefore you need to have the information that goes in there. And secondly, usually the pool sets up the block in a very specific way. They might put information, they often put information in the Coinbase in order to show which pool has mined this particular block. They might use multiple payout outputs in the Coinbase, who knows. And for the most part, so that you don't have to maintain a mempool and select transactions, they're also going to send you a list of transactions to put into the block. So the get block template basically is a call that your mining system, your software, your node, makes to the pool and says, give me a template for a candidate block. And it's a template because it's a candidate block. It doesn't have a valid proof of work yet. And the pool will send you that candidate block, and then you can start trying different nonces in order to find a proof of work solution. If you're lucky enough and you find it, you submit that back to the pool submits it to all of the other nodes it knows about, and collects the reward and then pays you out based on the share of the work you did. So that's what get block template does. All right, let me quickly check in the chat, see how we're going. Okay, we have some good back and forth, some clarifications about MetaMask in the chat, people pointing out that of course you can use MetaMask for a variety of chains and a variety of tokens on these chains. A really versatile tool. However, and this is important, I would not store my keys in a software browser-based wallet. A lot of people have lost money by making that mistake. So I would only use that either with a very, very small amount of money for testing purposes in the software wallet, or I would use it with a hardware wallet holding the actual keys and signing the actual transaction, so that MetaMask is just the interface to the blockchain and the keys are stored on my hardware wallet. All right, the next question comes from Joe. Bitcoin will not gain acceptance as a currency if everyone's transactions properties. So Joe, first of all, I'm going to challenge your initial assumption. Bitcoin will not gain acceptance as a currency if everyone's transactions are broadcast for all to see. First of all, it already has and is accepted as a currency in many places and in many scenarios. So that's not necessarily true. Secondly, if you look more broadly at what is used as a currency, many of the most popular solutions are completely transparent. When you use a credit card, your transactions are visible to not just the banks, but advertisers and intelligence agencies and various surveillance companies that monitor credit card transactions. But most people go further than that. They use payment mechanisms like Venmo that broadcast your transactions to everyone. And, and if you think Venmo isn't that big, in China, with various payment systems like Alipay and the WeChat payment system, etc., 1 billion people are using transaction mechanisms that are completely transparent and heavily surveilled. So has that gained acceptance as a currency? Yes, it has. Now, that doesn't mean we shouldn't have privacy. Quite the opposite. I'm a very strong proponent of very strong privacy, and financial privacy especially, as a fundamental human right. It's an important bedrock, especially as a fundamental human right. It's an important bedrock of democratic institutions, is your ability to engage financially with other people around you, including in the political sphere. So what are the current privacy solutions for Bitcoin users? Well, there's a variety of coin mixing technologies out there, like Join Market and CoinJoin, CoinSwap, etc. In addition to that, and you can use those with privacy supporting wallets like Wasabi and Samurai and things like that. Recently, Taproot was introduced as a soft fork and was locked in for activation. It will activate in November, in just about 3 or 4 weeks. We're going to see activation of Taproot, and that is going to be a significant privacy improvement. It can make complex script look like single payments and boost innovation and privacy for Bitcoin as a whole. But in general, to answer the last part of your question, can Bitcoin be just as privacy as a privacy coin like Monero without sacrificing its properties? This is a very tricky question to answer, and most of the people who I've talked to about this topic would agree that no, you can't. This is one of those fundamental trade-offs where achieving privacy as the primary characteristic of your coin or chain comes with some design trade-offs, and Bitcoin may not and probably is not willing to make those trade-offs. A very important trade-off is this: if you can't see the amounts that are being transacted in transactions because of something like confidential transactions, like Monero has with Ring CT, that prevent you from seeing the amounts, where the amounts themselves are encrypted. How do you know that no new coins have been introduced accidentally, also known as an inflation bug, where coins are essentially issued by transactions that are producing more coins than they should? Now, with confidential transactions, you have to have an encryption or zero knowledge mechanism called a range proof, which says, I don't know how much is going into this transaction, I don't know how much is coming out of this transaction, but what I do know is that, and I can prove through zero knowledge proofs, that the amount going out is less than or equal to the amount going in, and therefore it's zero sum or less than zero sum. There's no new coins being generated. However, those types of zero knowledge proofs have been found to have bugs, the most famous being an inflation bug that was discovered in Zcash. We don't think it was exploited, but we don't know. And the same thing applies to Monero. Now, for Monero, privacy is more important than ensuring the absolute soundness and provability of the monetary supply. But for Bitcoin, the 21 million coin monetary supply limit is a fundamental design principle. Bitcoin is designed first and foremost to be sound money, not private money. And if private money makes you less sound, then Bitcoin will not make that trade-off. So this is not an easy question to answer. However, I do believe that we can do a lot more with privacy in Bitcoin, and I hope we do see a lot more with privacy in Bitcoin over time, although it is getting more and more difficult. Olivier asks for the next question about public key and script versions. All right, a public key in hexadecimal can be reworked to produce an address using open source software, but the address differs by the address type. So pub key p2pkh, p2sh, p2wpkh, p2wpkh wrapped in p2sh. Why is this? This is because addresses represent essentially spending scripts or locking scripts. So an address is an encoding of the conditions required to unlock an amount. In the absolute simplest form, which is a legacy pay to private key hash, p2pkh as it's known, in the legacy address, which is an address that begins with 1 in Bitcoin, the address represents a script that says you need to sign with a signature that matches a public key whose hash is this. So the address in that case is a hash of the public key, which is why that type of address is called pay to public key hash, p2pkh. So that type of address represents a script, the most common script in Bitcoin, and a very simple script which says, show me a signature and I will validate it, and it has to match this public key's hash. But if you instead use a different type of address, then you're implying that there's a different type of script. And you can do an infinite number of possible scripts, even with just the basic operation of show me a signature for a public key. So let me give you a silly example. I can take the same public key and say, oh, it's not a public key, it's a one-of-one multisig. Well, what's a one-of-one multisig? It's show me a signature for this public key. But if I write it instead of p2pkh, I write it as a p2sh, pay to script hash, and the script is one-of-one multisig, and here's the public key that matches this multisig. It'll work. It'll produce a completely different address, one that starts with 3, that encodes a script, etc., etc. If you're using SegWit, then the address format is different. If you wrap the SegWit inside a script, then it's a p2sh, p2wpkh, or p2sh, p2wsh, which means that you have a witness public key hash or a witness script hash wrapped in a script hash. Or you can have a native SegWit address that starts with BC1, and that could be either a witness public key hash or a witness script hash. Essentially, as Bitcoin has evolved and new scripting capabilities are available, those scripting capabilities often require their own address format, so that when I send to a specific type of script, the wallet knows how to construct that script. And the way it knows is by looking at what kind of address. If I tell my wallet, pay this BC1 address, it's going to say, okay, BC1, that type of address is a native SegWit pay to wpkh, for example. And my wallet knows how to construct a script that locks the amount to that type of address. So addresses represent scripts. Often those scripts are very simple and just represent a public key, but they might not. And we have lots of different addresses and address types because as Bitcoin has evolved, we've expanded the scripting capabilities. Now, to the previous answer I just gave, in November, in a few weeks, Taproot is going to be activated. Well, Taproot introduces a new address format. This is an address format called P2TR, Pay to Tap Root. A Pay to Taproot address says the script for this is a Taproot script. It's not a witness public key hash. It's not a public key hash. It's not a witness script hash. It's a Taproot. And a Taproot script has a different structure. It actually has a tree of conditions. It gets complicated, but the bottom line is that's a new address format. And by having that address format, if I give that address to a wallet, that wallet will know how to construct a Taproot locking script so that it can be properly locked to that address. All right. There's a follow-up question by Olivia which says, what would happen if I paid Bitcoin into a pay to wpkh address? Would this also be reflected into the pay to pkh on a blockchain explorer, seeing they are derived from the same public key hex? The answer is no. If you make a payment to an address, other addresses derived from the same public key, which essentially represent different scripts that can be spending from that public key, will not see that amount because in Bitcoin you pay essentially to a script, always to a script, not a public key. And there is an actual pay to public key format which is obsolete and not used anymore. But everything nowadays in Bitcoin is a script, and as a result, if you change the type of script you use and you make a payment to that, it's not visible on the blockchain explorer in a different type of script or address. If you make a payment to a witness native SegWit address, that amount does not show up on the corresponding legacy Bitcoin address starting with a 1 or script address starting with a 3 for the same public key. And that was a very technical question, so if you lost me there, it's okay, don't worry. This is not something that you absolutely have to understand clearly to succeed in this course. It's very, very detailed. All right, so next question comes from Olivier again, and it's about XPub keys. From the previous two modules, we gained an understanding of how BIP39, which is mnemonic phrases, is used to derive a master private key which can generate multiple other private keys and their corresponding public keys. But where does the extended public key come into this? That's a great question. So when you generate the base keys of a hierarchical deterministic wallet, you don't have just plain keys, you have extended keys. So essentially from your mnemonic phrase, your 12 to 24 English words, you can generate an extended private key, or xpriv, which is a private key that can generate multiple private keys. But you can also generate a corresponding extended public key, which is a public key that can be extended to produce multiple public keys. So essentially you have two derivation paths. One is derive all of the private keys, and from each private key, get the corresponding public key. Which of course you can do, because from the private key you can go to the public key. A second path exists, which is very useful, which is derive all of the public keys. And from these, you can't go back to the private key on the other side. You only have the public keys, and you can derive all of the public keys, but you don't have any of the private keys, which means you can't actually spend or sign with the money. Now, where is this useful? It's incredibly useful in, let's say, e-commerce or watch-only wallets or shops. Because if I have a web server where I want to sell a product, or if I have a wallet where I want to receive payments from my business, I want to give each customer their own payment address so they can send payments to me, but I don't want to put the keys on a web server because that's incredibly dangerous. If I put private keys on a web server, they can be hacked and I have my money stolen. So what I can do instead is I can take the extended public key, and using the extended public key, I can put it on the web server. The web server can then generate a bunch of public keys and addresses from that extended public key, the XPub, and it can generate addresses to give a different address to each customer. Now, when the customers pay to those addresses, my web server can't spend that money. It doesn't have the private keys. It can't do signatures. All it can do is generate more address. It can see all the payments coming in, but it can't do anything with those payments. And I can keep my private key over here, my extended private key, on, let's say, a hardware wallet. And so effectively on my shop, I have just addresses with payments coming in, very secure. And the actual private keys are on a hardware wallet in cold storage. So if I want to spend the money that I've made in my shop, I have to pull out the hardware wallet and make a signature from there. So a very, very useful feature for e-commerce. And you can also do that to have a watch-only wallet, for example. Let's say you're in a company and you want the accountant to be able to see all the transaction, but not actually spend anything. Well, you can give them an extended public key. They can use that to see all of the addresses and everything that's happening in the wallet, but they can't spend anything. They don't have the private keys. Tatiana asks, I have practiced installing Electrum on my laptop. If I generate a new Bitcoin address in Electrum, will I be able to access it in my hardware wallet, given that the seed there has nothing to do with Electrum? No, you can't do that. So if you generate addresses from a seed that you have on your software wallet, Electrum, on your desktop, and those addresses have nothing to do with any of the keys that are in your hardware wallet. However, what you can do with the Electrum wallet is you can create a new wallet that has a hardware wallet connected to it. So what happens there, and this refers back to the previous question I just answered. You tell Electrum that you want to use a hardware wallet. It connects to your hardware wallet. You plug it in to your laptop, for example, and your hardware wallet gives Electrum an extended public key, or XPub, which says this is all my addresses generated from this seed. Electrum never sees the seed, never sees the private keys, but it does see an extended public key. Now, Electrum can generate addresses for the keys that are on your your hardware wallet, the private keys. Electrum can generate addresses, Electrum can construct transactions, but it can't sign. So it can watch all of the money coming in, going out, it can see all of the transactions on the blockchain, it can see all of the addresses that belong to your hardware wallet, but it can't sign. If you want to sign, you can construct a transaction in Electrum. You say, I want to send to this address, the normal wallet functions, and then when you're ready, you say sign, and it says plug in your hardware wallet. Plug in your hardware wallet, Electrum sends the transaction to the hardware wallet. The hardware wallet presents on the screen, hey, I've been told you want to send to this address this much money. You confirm it on the screen because you only trust the screen of your hardware wallet. You confirm with a button or something, and the transaction is signed and sent back to Electrum to broadcast to the blockchain. So this kind of combination is very, very common. You have a hardware wallet that controls the keys. You use that to do all of the signatures, and you have a very functional software wallet that is doing the same job as the software wallet that the vendor gave you. So, for example, if you have a Trezor hardware wallet, you can use that Trezor hardware wallet with Trezor's suite, or wallet.trezor.io. Or you can, if you have a Ledger hardware wallet, you can use it with the Ledger software. But you can also use your hardware wallet with dozens of other pieces of software like Electrum, and have that manage your transactions instead. And often they have much more sophisticated features. I quite like Electrum. I use it for my business because it allows me to do things like control fees very, very precisely, control which coins I'm going to spend very precisely. It allows me to do replace by fee and child pays for parent and all kinds of things like that, which are very convenient. But all of the private keys remain on the hardware wallet. So if you want to use Electrum on your laptop and you have a hardware wallet, generate a wallet in Electrum that is connected to the hardware wallet, and you will be able to use them together very effectively. Maximilian asks, I was wondering if the testnet was bound to the same rules as the mainnet. Just to clarify, testnet is the Bitcoin test network. In fact, there's several testnets. And mainnet is the production blockchain of Bitcoin. And I was wondering if there was a limited amount of testnet. Most testnet asked to send back the tokens. And does the ledger of the testnet something that miners have to accept to also run when deciding to mine real Bitcoin? So testnet in general follows all of the same consensus rules as Bitcoin's mainnet. And the reason for that is because one of the things we test on testnet is the consensus rules, so they have to be the same. So the testnet has a limit of 21 million coins. It generates blocks every 10 minutes. It has all of the same rules. The only difference is that in many cases the mining difficulty is much lower on testnet, so that you can mine it with some second generation ASICs. And of course the coins are worthless, which means that you can use that to test various applications. There's another form of testnet called Signet. Signet follows all of the rules of Bitcoin in terms of validating addresses and etc., and the 21 million coin limit. But, and this is a fundamental difference, Signet is not mined by miners doing proof of work. Instead, it's a federated proof of authority network where basically there are predetermined signers on the network, and they simply sign blocks to ensure that those blocks are valid. This means there is no mining difficulty on Signet, and this ensures that Signet can run in a stable way without the risk of somebody joining the network with an ASIC and driving up the difficulty. You see, the problem with testnet is in the past, someone will jump in with an ASIC every now and then, drive up the difficulty, and then leave, and then the chain stops moving forward because there isn't enough hash power to move it anymore because the difficulty's gone up. And then it takes 2 weeks for the difficulty to drop again, and it gets complicated. So Signet is basically a Bitcoin testnet without proof of work mining. And there's also RegTest, which is a testnet you can run on your local machine, which again does not have proof of work mining, where you can produce blocks as fast as you want, but otherwise follows all the same rules as Bitcoin. And these are great tools as a developer that you can use to test out applications and play with various concepts. All right, Javier asks about Softfork opt-in. What is the benefit for a node to not opting into new features coming from a soft fork? Do they lose any proof of work capacity or reliability vis-a-vis the closest nodes in the network? Is a later opt-in more costly for the node holder? No, there's zero cost really for the node holder. That's one of the fundamental ideas behind a soft fork, is that you don't have to do anything. You can simply continue. You don't have to upgrade your node, and you certainly don't have to accept features. For example, SegWit was activated on the network. You don't have to upgrade your node to continue to operate on the network. You could have left it in a pre-SegWit state and just stay there, and it would still work today. You would not be able to do SegWit transactions, and you would not be able to validate other people's SegWit transactions. Or rather, you would. They'd all validate as true regardless of the signatures in them. So effectively, other nodes are doing the validation. You're not fully validating the chain anymore because all SegWit transactions appear as valid automatically for you, and you're not fully validating the SegWit transactions, but you're validating everything else, and you're continuing to follow the chain. You can do transactions, you can track transactions, you can see balances, everything seems to work the same. You can't, obviously, construct SegWit transactions with that node. So you don't get the benefits of the new feature. Same with Taproot that is going to activate in November. You don't have to activate Taproot in November. You can say, I want to ignore Taproot. Your node will see SegWit v1 transactions and will ignore them. And they will appear as always valid. And you will continue to follow the chain and validate everything else. But you can't use Taproot in your own wallet on that node. So there's no benefit really to opting out other than deciding you don't want to upgrade your node, you don't want to use the new feature, you want to stay in the same mode that you were before. Eventually it's going to become a bit difficult for you because you would have to keep making small adjustments to your node settings in order to be able to move forward with the chain and to update the software version on your node without accepting the new features, because you'd have to fix various security bugs and problems that might be discovered as time goes on. Gorav asks about full nodes. A full node can be a seeding source to another node. What is an incentive to be a seeding source to another node? That is a very good question. So what is a seeding node? Let's say if you're running a full node, you have a full copy, an archival copy of the entire blockchain. That means that when another node boots up and has no copy of the blockchain, it's going to start asking for blocks starting with block 1. All nodes have the genesis block, block 0 already encoded. They're going to ask for block 1 and then block 2 and then block 3, and they're going to start downloading the blockchain from other nodes around them. So when I'm running a node that is a full archival copy, I am by default a seeding node on the network. That means that I am giving other nodes blocks when they ask for them, and that means that if somebody is downloading the entire blockchain from the genesis block forward, they may come to my node and start asking for all of the blocks, which means they're going to download 200 to 300 gigabytes of data from my node. So I'm serving up 300 gigabytes of data. What is the incentive? There's no incentive. In fact, it's costly and painful to do that. So the real reason you would do this is an altruistic reason. You want to maintain the health of the network. So, you know, in all honesty, it costs me probably about, well, it costs my business about $400 a month to provide several nodes on the network that are seeding nodes that provide a full copy of the blockchain and that upload up to 15 terabytes per month of blockchain copy to new nodes that ask for them. Now, I choose to do that. I can configure my node to say I'm only going to give, you know, 200 gigs a month, 100 gigs a month, and so I'm still seeding a bit. But once I've reached that limit, my node is going to say, no, sorry, I can't give you any more blocks. And they'll have to go somewhere else. In my case, for these nodes, I've set them to a 15 terabyte limit. And so they're providing 15 terabytes and I have to pay for that bandwidth. So my company pays for that. There's no incentive to do it and it costs money, but it's part of maintaining the network. Second question, can an introduction of a hard fork logistically affect data maintenance for a full node running an old version? Yes, absolutely. I mean, in general, running a full node requires maintenance. You have to upgrade it every now and then. Not immediately, not all the time, not to every version. But you don't want to fall too far behind because we are seeing optimizations in efficiency, we're seeing new technologies being introduced, and we're also seeing bugs being fixed all the time. So with every version, you get bug fixes and improvements and optimizations. You want to try to keep up with versions. And that means every now and then, I have to log on to all of the Bitcoin nodes and other nodes that I run, and download the latest version, compile it, confirm it, do the integrity checks, run it on a testnet, make sure it's working correctly, check the configuration, see if anything's changed, restart the node, monitor it for a bit, make sure it's working okay, and then go through and do that with all of my nodes. And I do that on average every about 3 months. It takes me about a day of work to do it. Obviously, I'm running quite a few nodes and quite a few different blockchains. So, but that's part of what I enjoy doing, and it's part of my job. So a hard fork would actually increase the amount of maintenance you need to do, because a hard fork requires you to do that upgrade before the hard fork, in preparation for the hard fork, so that you don't get kicked off the network by exiting consensus, essentially. So if we had hard forks in Bitcoin, which we don't really, then you would need to plan ahead, and it requires massive coordination so that everybody's ready, so that when the hard fork happens, not too many nodes drop off the network. Inevitably, there will be hundreds, thousands of nodes that don't upgrade because they're a box sitting in a closet somewhere that someone's forgotten about, and those don't get upgraded. And as a result, when the hard fork happens, those end up falling off the network. That's a necessary thing. So that's why hard forks aren't done very often, and in Bitcoin, not at all. There's no appetite by the community to do a hard fork because it requires massive coordination, months of planning, sometimes years of planning, in order to pull something like that off. Now, this is a design decision. Some blockchains, like Ethereum, for example, do hard forks all the time on purpose in order to keep everybody moving forward. The same is true of many other blockchains that prefer to do hard forks at least once a year to keep things moving forward. But that's not Bitcoin's culture. Javier asks about real-time quotes of Bitcoin prices. Let's see. So Javier asks, are exchanges themselves calculating a market price according to the transactions taking place within them, irrespective of the moment when the exchange sends those transactions to the network for confirmation? Yes, the exchanges calculate the market price in real time based on the orders that happen within these exchanges. And these orders are held on the exchange order book. So an order is somebody is bidding to buy, say, Bitcoin, and someone is asking a price to sell Bitcoin. So bid, ask, and these are matched in an order book, which is basically a database. And then when the order is completed, the account balance of the two participants is updated to reflect the exchange of Bitcoin to US dollars or whatever, the buying and selling that's happening. At that moment, when a bid matches an ask and an order is completed, when order matching happens, the exchange updates the market price based on the latest price at which two participants agreed to buy and sell a currency. So if you and I agree to buy and sell Bitcoin for a specific price, that is the current market price. Now, the exchanges don't simply change the price every time someone makes matches an order, because some orders are big and some orders are small. So what they usually publish is a rolling weighted average, which means that they average the price across multiple orders, and they weight it according to how big those orders. If I buy 10 Bitcoin and you buy 0.1 Bitcoin, the price that you agreed and the price that I agreed are not measured the same. Mine is 100 times more important in calculating the average because I'm doing a much bigger order. So the exchanges will reflect that, so it's called a weighted average. And it's a rolling weighted average because essentially they're moving forward with new orders as they come in and adjusting the average smoothly so that you don't see price changes that are too abrupt. And that's basically it. That's how a single exchange calculates the market price on its own order book. Now, you asked, do they send these transactions to the network for confirmation? They don't. No transactions occur on the Bitcoin blockchain because of orders matched in an exchange. All of this stuff happens internally in the databases of the exchanges. The only time a transaction occurs on the blockchain is when you do a deposit or withdrawal from the exchange. The buying and selling that happens all the time happens only in the database of the exchange and is not recorded on the blockchain at all. So nobody gets to see that. The sub-question is this why prices differ between exchanges at any point in time? Is it true that the larger the exchange, the more accurate the market price proxy is, given transaction volume should also be higher? Yes, well, different markets have different market prices. So you could see a different price for Bitcoin on one exchange versus another, simply because the people trading on that exchange are willing to take a different price for the same cryptocurrency as the people trading on another exchange. Now, these prices differences can't be too large, because if they are too large, they create an opportunity for profit called arbitrage. And this is where you say, okay, well, Bitcoin is cheaper on, let's say, Coinbase and more expensive on Gemini. Well, if it's hard, I'm going to buy Bitcoin on Coinbase, it to Gemini, and sell it on Gemini and make the difference. And of course, people do that all the time. And if you do that, what you're doing is you're actually pushing the prices back together. So through the process of arbitrage, through people taking advantages of small differences in price to make a profit between, they actually normalize the prices between exchanges, and they end up being very, very close to each other. Now, where you see big differences in prices between exchanges, that's because the flow of arbitrage has been disrupted. So if I buy Bitcoin on one place and move it to the other place, great, I can move the Bitcoin easily. But I also need to move US dollars in the opposite direction to continue that cycle. And that's where it gets slower. And if one exchange is in a place where maybe they have currency controls, or wire transfers are slower, or whatever, the opportunity for arbitrage is either slowed down or disrupted completely, and then you can see the difference in price increase. Essentially what you're seeing there is that your dollars go further in one exchange than they do in the other, whereas Bitcoin is the same. So essentially you're getting a discount on dollars because you can't move them out as easily. So arbitrage basically changes these differences. And how do we look at the overall market price? Like when you go to a website like CoinMarketCap or CoinCap.io, or if you look at the Chicago Mercantile Exchange Bitcoin reference rate, where I'm part of the oversight committee that controls that rate, what are you seeing there? What you're seeing there is an aggregate picture that takes information from several exchanges and then adjusts it again with a rolling volume weighted average. So it takes the average market rate for each exchange, it weights it according to the transaction volume or market volume that's happening on that exchange, and then it averages together with the other exchanges and provides you the one picture of what is the price of Bitcoin today across the world. If you look at, say, CoinCap.io, you're looking at the average across 25, 30 different exchanges, and that gives you a much smoother perspective of what the price of Bitcoin is. That's a good question to end on. Not one of the usual questions we get on this course, but an important aspect of these systems is to understand how the markets around them work and how price discovery happens. So thank you for that question, Javier. And that's all we have for today. I'll see you again, probably from a hotel room in a week. Now remember, next week's live Q&A has been moved to a Saturday because unfortunately weekdays I cannot, I have some other obligations. So I will see you on the following Saturday for week 6 of the massive open online course for the University of Nicosia's master's degree in currencies. I'm Andreas Antonopoulos and I'm your teacher, and thank you so much for coming today. Bye-bye.